Hello friends, welcome back to another lecture. Now this lecture is important for all JAIIB accounting paper candidates and all CAIIB ABA module B candidates. Not only this, candidates preparing for CCP, they also need to watch this lecture very carefully. But before that, don't forget to like this video since this tells me that you are loving the content and also motivates me to make more such awesome lectures. Also subscribe to this channel since this is the only channel that provides quality content. You can also join my Telegram and Facebook group where I post lots of one-pagers and other important stuff which is very important for your examination. So do join after you finish this lecture. All the links are there in description to this video. So without any delay, let's start with today's lecture. Friends, with concept of NPV clear to you, you won't find profitability index much difficult to grasp. So if you have 50 lakhs to invest in say 5 business or investment opportunities, then how to select which opportunity to go for? Yes, you can use NPV here. Yes, you can also use payback period here. But ultimately after recovering your capital, what everyone is looking for is profits only, isn't it? So here comes a very important metric called Profitability Index, which is capital budgeting tool used to rank projects based on profitability. Please note that Profitability Index is also known as Profit Investment Ratio, that is PIR, or Value Investment Ratio, that is VIR as well. So do remember this important fact. Next friends, the formula to calculate Profitability Index is pretty simple. That is Profitability Index equals present value of future cash flows divided by initial investment. So you can see the formula does look pretty simple, isn't it? All you need to do is to find out present value of future cash flows and then divide it by initial investment of the project. That's it. Now friends, there is another way in which we can express profitability index, and that is through net present value. So this alternative formula of profitability index is that is profitability index equals 1 plus net present value divided by initial investment. But friends, if you look carefully, then both these formulas are actually same. Let's see how. So just solve this equation here. Now we can write this second formula as that is profitability index equals initial investment plus net present value divided by initial investment. I hope this step is clear to you. Now as we have learned in previous NPV lecture that NPV is nothing but summation of initial investment plus present value of future cash flows. I hope you all remember this, and this initial investment is negative here. So please note we take this initial investment negative while calculating NPV because it's a cash outflow. So numerator becomes initial investment plus negative of initial investment plus present value of future cash flows divided by initial investment. Now this initial investment cancels out and we are left out with profitability index equals present value of future cash flows divided by initial investment, which is nothing but our first profitability index formula only. But please remember both these formulas since both are used extensively in the questions. Now friends, before moving ahead with the lecture, don't forget to get your JAIIB and CAIIB resources from the links given in description to this video. These are 5 power-packed JAIIB books which will be delivered straight to your location anywhere in India. Over the years, students have found these books extremely beneficial in their journey of clearing JAIIB. Then these are CAIIB resources and all these comes with lots of case studies and detailed explanations. So don't miss out on these after you finish this lecture. These will be delivered anywhere in India. So just get these from the links given in description to this video. Now let's move forward with the lecture. Next friends, how to interpret this profitability index. So please note if profitability index is greater than 1, then the project generates value and the company may want to proceed with the project. So if index is more than 1, then investment is beneficial because you may earn back more than you invest in. So if you find any investment whose profitability index is more than 1, then you may go ahead and invest in it. Then next, if profitability index is less than 1, then the project destroys value and the company should not proceed with that project. So friends, if index is less than 1, then it's better to stop yourself and look for other opportunities. Because when profitability index is less than 1, then this means you won't get your money back that you have invested. Then why to invest in such projects or investments? Lastly friends, if profitability index is equal to 1, then the project breaks even and then the company is indifferent between proceeding or not proceeding with that project. So if index is equal to 1, then it's an indifferent or neutral project. So you should not invest in a project until and unless you consider it better than other projects available during the period. For example, if you find that profitability index of all other projects is negative, then only you may consider to invest in this project. So in short, the higher the profitability index, the more attractive the investment is. So friends, I hope the decision making with respect to profitability index is clear to you. So this is all the theory that is required in profitability index concept. Let's do some questions and case studies that will make concept crystal clear to you. And the first question is, the Indraprastha Corporation investment has an outlay of 50 crores, a present value of cash flows as rupees 63.13 crores and net present value as 13.14 crores. The profitability index is, and these options are given to you. Friends, please recall we already learned these two formulas for finding profitability index. Let's find it by first formula, that is profitability index equals present value of future cash flows divided by initial investment. So in the question we are given present value of future cash flows as rupees 63.13 crores and initial investment is given as 50 crores. So profitability index will be simply 63.13 divided by 50 equals 1.26. Thus the correct option for the given question is option D. Next friends, please note this question can also be solved using second profitability index formula since NPV is also given to us. So let's apply that formula, that is profitability index equals 1 plus net present value divided by initial investment. Now in the question net present value is given as 13.14 crores and initial investment is given as 50 crores. So profitability index will be 1 plus 13.14 divided by 50 which equals 1.26. So as you can see, we are getting same answer using both the formulas. Then next we have a case study. A company is considering the purchase of a copier that costs rupees 5 lakhs. Assume a required rate of return of 10% and the following cash flow schedule, that is for year 1 cash flow is rupees 3 lakhs, for year 2 it's rupees 2 lakhs and year 3 it's rupees 2 lakhs. Now answer next 3 questions based on data given. And the first question is, what is project's payback period? And these options are given to you. Friends, I hope you all remember last lecture on payback period. So as you can see, cost of copier is paid back in exactly 2 years since cash flow for year 1 is 3 lakhs and for year 2 is rupees 2 lakhs and sum total is 5 lakhs which is nothing but cost of copier. Thus the correct option for the given question is option B. So no need to apply any formula of payback period here. So the correct option for the given question is option B. Then next question is, the project's discounted payback period is closest to, and these options are given to you. Now friends, you have already learned payback period, but you must be wondering what's this discounted payback period? Friends, the difference between usual payback period and discounted payback period is that in normal or usual payback period, we are using cash flows as it is while finding payback period. While in discounted payback period, we first discount, that is find the present values of all cash flows and then add them to find payback period. Let's see how we do this in this question. So as you can see, discounted cash flow for year 1 is rupees 2,72,700. Then discounted cash flow for year 2 is 1,65,200. So cumulative cash flow will be 272,700 plus 165,200 equals 4,37,900. So as you can see, remaining amount to recover is 5 lakh minus 4,37,900 equals 62,100, which we will recover in third year. So let's apply our payback period formula here. That is payback period equals years before break even plus unrecovered amount divided by cash flow in recovery year. Friends, here years before break even is 2. I hope this is clear to you. Then unrecovered amount as we have found earlier is 62,100. And then cash flow in recovery year is 1,50,200. Please note here also we are using discounted cash flow instead of normal cash flow. So discounted payback period equals 2 plus 62,100 divided by 1,50,200 equals 2 plus 0.413 equals 2.4 years. So as you can see, in discounted payback period, we work with discounted or present values only. Thus the correct option for the given question is option C here. Next, let's see final question of this case study. What is project's profitability index? And these options are given to you. Now friends, we already know that profitability index equals present value of future cash flows divided by initial investment. Now present values of future cash flows we have already found in previous questions. So present value of year 1 was 2,72,700. Then year 2 was 1,65,200. Then year 3 was 1,50,200. Which adds up to 5,88,100. And the initial investment was 5 lakhs. So profitability index will be simply 5,88,100 divided by 5 lakhs equals 1.18. Thus the correct option for the given question is option B. So friends, I hope this case study is clear to you. Next, let's do a final case study that will make the concepts of NPV, payback period and profitability index crystal clear to you. Now this case study is assignment for you, but ABM case study course students can find full solution inside the course. And the case study is: Jaspreet has been retained as management consultant by Big Bazaar to analyze two proposed capital investment projects, that is Project X and Project Y. Now Project X is a sophisticated working capital and inventory control system based upon a powerful personal computer called a system server and PC software specifically designed for inventory processing and control in the retailing business. The next Project Y is a similarly sophisticated working capital and inventory control system based upon a powerful personal computer and general purpose PC software. Each project has a cost of Rs 10,000 and cost of capital for both the projects is 12%. The project's expected net cash flows are as follows. Now these expected net cash flows for both the Project X and Project Y are given here. So answer next 3 questions based on data given. And the first question is: what is payback period for Project X and Project Y? And these options are given to you. Now friends, please pause the video and try to solve the questions yourself. If you understood the lecture on payback period, then you can very easily solve this question. The next question is: what is NPV of Project X and Project Y? And these options are given to you. And the final question of the case study is: what is profitability index for Project X and Project Y? And these options are given to you. Now friends, please pause the lecture and try to solve all this question. Post your answers in the comment section, and my like to your comment means that your answer is correct. So with this, I wind up this lecture. I hope all the 3 concepts of NPV, payback period and profitability index are clear to you. Lastly, don't forget to get your JAIIB and CAIIB resources from the links given in description to this video. So thank you, and I will meet you again in another lecture.